Thank you, everyone. Well, it's a pleasure to be here. Thank you, Tajinder, for joining me.
Thank you. It's a pleasure.
Tajinder is the founder of Invesia and an executive in so many companies. You can watch his shirt. And today we have a very thought-provoking title for our talk. If 90% of traders lose money, who's actually making it? I would like to focus first in the first half of this title. Okay, if 90% of traders are losing money, because that's a lot, really. Why do you think it's that?
I think there are multiple reasons for it. Obviously, leverage, mis-selling in the name of financial inclusion, as we say. Complexity of the products. The very simple, example is, so let's go fact-based, right? There are a total of 58,000 stocks in the whole world. In the entire world, you only have 58,000 stocks. There are about few tens of millions of financial instruments that are based and built on top of those 58,000 stocks. Your indices, S&P 500 indices, MISCI indices, HFRI indices, wisdom tree indices, so on and so forth. Then you have futures, options. You have within options, you have look-back options, knockout options, barrier options, Asian options, put option, call option, and I don't know what other kind of options, for God's sake. Binary options, we forgot them as well, right? So it's the complexity, the leverage, the mis-selling, and the misrepresentation that I believe has created sort of an ecosystem where whenever I look at on an average, the growth of investors in terms of percentages or in terms of what they're doing, I always reach a point where I see stagnation and then a drop, which sounds very counterintuitive to how many people are trying to bring these products to the market. So if you look at just US market, because SEC publishes the numbers for employees of brokerages and financial services companies, there are about 200,000 salespeople working in the brokerage industry of US market alone. Expand that globally, you're looking at a number between 1 to 2 million salespeople for selling 58,000 stocks. Doesn't add up.
Yeah. So I think that one of the problems here is that, and I think that we all agree, on one hand, providing access to the financial markets, it's something that should be positive and that we could rally around, this idea of democratizing access to the financial markets. And here the good part is that incentives are aligned, and it's good for the companies to bring more people to the financial markets, and it's good for people, in theory, to have access to the financial markets. But then where the incentives start to get misaligned is to do what there, And when you look at the volume of the amount of people that are in sales, you start to understand, okay, maybe they are not there just to help traders. No?
Yes, and you're right. Financial inclusion is very important. As a matter of fact, I was having a conversation with one of my friend, and because Finvesia also happens to own, digital banking ecosystem, payments ecosystem, brokerage ecosystem, cryptos ecosystem, and we are across all the major, verticals of financial services. He suggested me, Natty, why don't you go and work towards financial inclusion in banking sector for people who don't have access to all these bank accounts, which is very similar to trading as well, and I'll come to that. And my answer was, when I look at this larger, market sizes, we talk about Africa, we talk about India. India has such a large population, it's almost like the entire Europe in terms of languages, different cultures, availability of capital stuff, so on and so forth. They don't have money for it. And practically, why would you want someone to invest or someone to open a bank account when he does not have access to basic healthcare, he does not have access to basic education, he does not have access to basic amenities? It does not bring too much value to try to do that. And then another friend of mine questioned me, well, financial inclusion is good. But if you think about it, did financial inclusion actually happen? Over last 20 years, if you look at stats from US, you look at stats from UK, you look at stats from different countries, as per the Gallup report, there were about 62% households in US that had some sort of exposure to the stock market or to the capital markets. This is early 2000. Today, that number is still between 60 to 62%. Go to UK. The numbers are from LSEG. They suggest early 2000 there was 30% of UK citizens and residents who had some sort of an exposure to the capital markets. Today that number is 18%. And if you further look down the numbers and you dig deeper into the numbers, you see that the top 8 to 9% of US individuals own more than 80 to 90% of the exposure on the capital markets. How did how did the inclusion happen to begin with when we had millions of people sitting in sales, working across the world, trying to bring in traders and investors for last 20 years, and we see the percentage terms of financial participation decrease while the capital markets increased 5 to 7 folds in its value? Where is the financial inclusion?
So do you think we are not doing quite a great job at democratizing access to the financial markets?
I think we are. I am from financial markets. I love my industry. I think we are trying to do an ethical job. But I think somewhere maybe it doesn't trickle down as well. Somewhere there is a gap that needs to be plugged in, that needs to be filled in. And it's almost like smoking industry. I mean, we all know that, if you're smoking, there is 10 to 20% chance, only 10 to 20% chance that you will get hit by lung cancer. But still, every pack of cigarettes says smoking is injurious to health. You have a photograph of someone with a broken face because he had cancer, his lungs is out, he's dead, sitting by his wife on a deathbed with just 10 to 20%. On CFD market, I see 90% people losing money, almost 100% people suffering from stress. Okay, not 100, maybe 99% people suffer. Where is that disclaimer?
Well, there is the disclaimer, no? So
in Europe, yeah.
In Europe, yeah, that's true. So that's a spicy comparison with the tobacco industry, but the idea of, for me at least, the idea of having more freedom to choose is not bad, it's good, but I totally agree with you that should come with knowledge, and that should come with education, no? And sometimes probably the industry is not helpful. And it's not providing that because it's not in its own interest. No? So where do you think that are the incentives misaligned exactly in this regard?
I think the incentives should focus more towards AUM, asset under management, than focusing more on volume. We are all brokers over here, and we understand that industry talks about something called ARPU, average revenue per user. And average deposit per user, and we know that there are these percentages of ARPU that relates to average deposits. I think those KPI numbers probably don't align well. If you think about it statistically, when we're talking about masses and mass inclusion, we are talking about something that has to be systematically and statistically correct. And statistically speaking, I know from the research that I've read and the ones that's published by regulators and exchanges, more than 90% of people lose money when they are trading in futures and options, which is obviously because it's a zero-sum game and then there's friction and all those things. But there is less than 1% people who lost money when they are investing in stocks over a period of 10 to 15 or 20 years. Maybe the incentive should go towards asset under management, should go more towards how much an average client of a broker has in his portfolio. And maybe they will create a shift towards going where we are disaligned from the volume that's been created, more towards how much asset is sitting in a given individual's account. And that is where industry wins and the client wins, because you have a client for 10, 15, 20 years for a generation, if you make $5 from a client, $10 from a client for 25 years, versus if you make $2,500 from a client for 6 months and then have to find a new client after 6 months, you're better off going for the longer term. And for the same reason, if you look at valuation multiples of forex brokers versus stockbrokers, with the same revenues, same EBIT, stockbrokers tend to have 10 times more the valuation multiple than a CFD broker for the same reason, because the churn is so high. So if we can reduce the churn, if we can bring in more incentive towards AUMs or maybe on those lines, possibly we would see more conversions. And we look at statistics that work at a larger level, because teaching me or you or somebody else how Head and Shoulder works isn't going to make me rich.
That's interesting. I totally agree with this idea of the industry looking more for the longer term rather than short term. Do you think there has been an improvement or not? Because I hear more brokers talking about retention of traders, which, I don't know, 5-10 years ago, no one cared about that. So do you think that we are towards the right direction or not?
I think the statistics tell us that it takes 7 times more money to get a new investor or a trader than to retain what you already have. There are 2 sides of retention coin. One is what regulators have also pointed out, and I speak to a lot of regulators across the world as well, is retention using call centers. The second is retention using knowledge, retention using other methods which are more driven by knowledge, driven by retention because of the portfolios. I think the second model is much better, and that's why regulators have a specific viewpoint regarding retention teams to work a certain way. So retention is important, but retention will be there if people maintain their portfolios. If you lose your disposable income trading, retaining you is almost like, I think the product mix has to be more appropriate than just making sure that people stay in the market.
Okay. And what's the solution to this problem? What's the type of offering that should be prioritized?
Simplify the products. They are not for the retail guys. Keep things simple. They always win. Remove leverage from the ecosystem as much as you can. Bring in more education-led, education-driven ecosystem, and change the KPIs. From volume to something else that aligns, the incentives. If I, as an industry, if I'm a hospital and 90% of my patients die, I'm probably not doing a good job. So if we know the statistics and we understand as an industry, we've seen the statistics that at large has worked against our clients, maybe the interest needs to be revisited and someone will do it. Whether it's us, whether it's you, whether it's somebody else over here, someone will do it and they will show leadership coming in. And I believe once we have a few examples that build leadership of profitable business built on these kind of principles, the industry will reward it and follow it, and the clients will reward it, because we are not redefining the category. We are going back to the basics over here.
And well, Finbasia is a big name in the industry. You are a pillar of this industry. What are you doing to help in that regard?
We are trying to simplify. We are looking at each one of our product into financial markets. We happen to have launched a platform called dealing.com with the same intent, with the same hope that we would probably bring in something that will lead to more product that is driven by AUMs of the client, retentions of the client. 95% of our products are going to be zero leverage. It's going to be one-to-one, no leverage on those instruments. We want to bring more diversification. If you're sitting in one country and you want to invest across the world, you should be able to do that. As a matter of fact, an average brokerage platform has maybe 5,000 instruments on it, stocks and stuff like that, while there are 58,000 stocks in the world. Dealing.com comes out with 30,000 on the get-go itself. But the sense is to build something that probably can create that leadership in the industry for leading without leverage an ecosystem where financial inclusion can grow.
I agree that leverage can be harmful, but at the same time, many traders, especially new traders, say, well, but without leverage, there is not that much upside because I don't have I don't have that much disposable income or starting capital. So how do you balance this argument?
So that every argument has two sides to it. Nothing is absolute and standard. Leverage was seen as empowerment. I have leverage, I have empowerment. I have $500 that I can risk in my account, but I want to trade for $50,000. I go in, I take 100:1 leverage. If you go back to the history of economy, we have recorded history of economy going back to 1929, 1933, 1987, 2007, 1999, all of these ones. Every single time there is a financial crisis or an economic crisis that happened across the world, for all of these economic events, it was because of leverage. So is leverage really an empowerment?
Yeah, probably it's a misunderstanding, no? And in my opinion, it's important to have the freedom to choose, but as far as you have the knowledge on how to use this power, no? It's a double-edged sword for sure. So, and why the name of dealing then?
Dealing, so we launched it as dealing.com. Dealing, as per Oxford Dictionary, means buying and selling of financial instruments or commodities. Mm-hmm. So at the very fundamental level, dealing is dealing. We are dealing against maybe stocks versus cash, commodity versus cash, stuff like that. And because we are looking at this industry at a very fundamental level, how dealing happens across the world, how dealing should happen across the world, that is where I believe the name did justice to it, and that is why we believe dealing.com does the right justice to question the fundamental underpinning of how dealing should happen in the world. So we hope it does justice.
That's interesting. Well, we'll keep an eye on this. In the end, having access to the financial markets is just the first step. If you have a rod, then you need to learn how to fish. And it's positive for the industry that we have several options, and that we have some of them that are really trader-centric and investor-centric, that are focused on helping people build wealth with their disposable income. I think we don't have more time. No questions allowed. I'm sorry. I hope you enjoyed the conversation and have a wonderful day. Thank you.
Thank you so much.